Hello everyone, welcome to today's video. On this video, we will be discussing about an economic case study in which in a few countries, everything that could possibly go wrong went wrong. Whether it was the industrial policy, the financial policy, the monetary policy, all these policies were in shambles. This was the 1997 Asian financial crisis. Countries which were seeing 7 to 10% GDP growth year on year saw their GDP growth falling drastically. And this is not something which happened in the history of the world for the first time. This has been seen several times. Financial crises keep on occurring. Whether it is regional in nature or global in nature, financial crises do happen. So this will be an economic case study where we will be discussing why this crisis happened, what were the consequences of this crisis, how did they recover from this crisis, and what are some of the lessons that rest of the countries and the whole global economy can learn. A quick introduction about myself. I am Ayushi. I am an economist. I have worked with the government of India for the past 7 years, and I've also worked as a public policy consultant before that. I have done my graduation in economics from SRCC and also my master's in economics. So let's talk about the 1997 Asian financial crisis, which shook the Asian countries. The Asian financial crisis, also called the Asian contagion, was basically a crisis which affected primarily the Asian countries. It started in Thailand in 1997 and quickly spread over to other Asian countries. So before we jump into what exactly happened, let us try and set the context. So this was the period of 1980s and 1990s when a lot of these economies were booming. GDP was increasing. There was a lot of export-led growth. That means there was a lot of exports that were happening from these countries. Government was providing a lot of subsidies, a lot of financing and favorable policies to businesses and manufacturers. However, this growth was accompanied with a lot of risk. What were these risks? We'll discuss them one by one. So while this economic growth attracted significant foreign investment or hot money, which basically means that there was a lot of short-term inflow of capital into these countries, this also created a sort of an economic bubble, which basically means that there was an over-optimism about the growth of these economies, and there was a belief that this growth cannot be stopped. And hence, there was a kind of an economic bubble which was created. Secondly, the banks and the financial institutions, they started giving out huge loans to corporate houses and households without proper risk assessment. They were not necessarily the best suited or the most efficient ones, but they were closest to the center of power. And this situation is called as crony capitalism. This is the term of the day, and do let me know what you mean by crony capitalism and if you have observed this kind of situation in any of the economies in the present day. So the massive inflow of hot money with risky lending practices without proper risk assessment and accompanied by crony capitalism was a major factor for the downfall of these economies. Now, several East Asian economies had fixed exchange rate regimes in that time, which means that they used to peg their currencies to the US dollars. For example, before the crisis, the Thai baht was 26 Thai baht to 1 USD, which basically means that this exchange rate had to remain fixed and it cannot be manipulated or changed. Now, pegging a currency to the US dollar implies maintaining a fixed exchange rate between the domestic currency and the US dollar. This fixed rate provides stability by reducing uncertainty for businesses which are engaged in international trade and investment, because it kind of offers a predictable environment for economic planning. It also encourages foreign investment and promotes trade by making prices more transparent and predictable. The investors know that this is the rate at which they have to buy US dollars or sell US dollars, and hence there is a kind of stability and certainty in the environment. However, there are certain vulnerabilities also. For example, the external shocks which are seen in US can also affect the countries who have pegged their currency to the US dollar. Moreover, the country's central bank loses its autonomy to change its currency's value according to the economic situation in the country, because they have to maintain that fixed exchange rate. And this exactly was what was seen in the 1997 Asian financial crisis. In the mid-1990s, a series of external shocks began to change the economic environment. As the US economy was recovering from a recession in the early 1990s, the US Federal Reserve Bank, or its central bank, began to raise its interest rates to fight off the inflation. Now, this made United States a much more attractive investment destination relative to Southeast Asian countries, which had been attracting hot money and capital inflows into their economies. Now, as the interest rates rose in US economy, money started flowing from outside to the US economy, and hence the US dollar appreciated. Now, as their currency appreciated, it hurt their exports because it was now more expensive to buy the goods and services from these Southeast Asian countries, and hence the export-led growth that these economies had seen started declining. Another major pillar which led to a decline in these economies was the weak financial sector and the risky investments. I talked about how these banks and large financial institutions, they were giving out loans to businesses which were close to the center of power, but these institutions are also giving out loans without having proper risk management systems or regulatory oversight. They engaged in risky investments. They started investment in real estates and stock markets, leading to asset price bubbles. So there was not only a growth bubble which was seen, there was also an asset bubble in the form of real estate bubble and stock market bubble which was seen in these countries. As the Asian financial crisis hit, a lot of these loans were defaulted. This led to non-performing loans surging, and it led to a lot of banks failing. Thus, the government had to intervene to bail out these banks in order to restructure the financial institutions and protect the money of the people. As foreign investors, they attempted to withdraw their money. The exchange market was flooded with the currency of these crisis countries, and this put a pressure on their exchange rate to depreciate. But to prevent this outflow of money, the countries did something which further hurt them, which was increasing the interest rate. They thought if they increase the interest rates, then the investors are not going to pull out their money. However, having high interest rates also ensured that people could not borrow more, and there was a saturation in demand. In fact, the demand started falling, which hurt economic growth further. Soon these countries started running out of the forex reserves or the foreign exchange reserves, and Thailand was the first country to run out of foreign exchange reserve, and hence the crisis started from Thailand itself. Now, what were some of the impacts of the crisis? If we look at the data, then the Thai baht had been trading at about 26 Thai baht to $1 before the crisis, but it lost half of its value by the end of 1997, falling to 53 Thai baht to $1 by January 1998. The South Korean won fell from about 900 to the dollar to 1695 by the end of 1997. Indonesian rupiah, which was trading at about 2400 to the dollar in June 1997, plummeted to 14,900 by June 1998. So this financial crisis, which began in the late 1990s, had significant large-scale consequences on the affected countries as well as the global economy. So let's discuss some of these consequences. First was economic recession. The crisis triggered a severe economic recession in many Asian countries, including Thailand, Indonesia, South Korea, and Malaysia. These economies experienced sharp contraction in economic growth, a very high unemployment rates, and a decline in the living standards of its people. Second was the currency devaluation. As the crisis unfolded, several Asian countries were forced to devalue their currencies. And moreover, there were inflationary pressures. There was a decline in the purchasing power of businesses and individuals. This led to a loss of investor confidence. A lot of money which was pouring into the countries started flowing out, and hence the economic growth suffered. The third was the financial sector collapse. The crisis exposed weaknesses in the financial systems of the affected countries. Many banks and financial institutions, they faced insolvency. It triggered a collapse of the financial sector as a whole. Now, the Asian financial crisis also had a contagion effect, which meant that it was spreading beyond the initially affected countries. Finally, the long-term economic impact of the Asian financial crisis was that while some countries were able to recover relatively quickly, others experienced prolonged economic distress and challenges. South Korea, Indonesia, Thailand were the countries which were most affected by the crisis. Hong Kong, Laos, Malaysia, Philippines were also hurt by the slump. Brunei, mainland China, Japan, Singapore, Taiwan, Vietnam were less affected. However, they also suffered from a general loss of demand and confidence in this region. The third segment of this video is about the reforms which were implemented to tackle the Asian financial crisis. Now, during and after the Asian financial crisis, several reforms were implemented in the affected countries to address the underlying issues and prevent future such crises. So, some of the key reforms was the financial sector reforms. The weak and insolvent banks and financial institutions were either closed or merged to strengthen the financial sector. Stricter regulations and supervisions were introduced to improve transparency, risk management practices were introduced, and corporate governance was improved upon. The second was the structural reforms. Now, countries implemented structural reforms to address underlying weaknesses in their economies. These included measures to liberalize markets, promote competition, attract foreign investment, and diversify their export base. The aim was to enhance economic resilience and reduce reliance on short-term capital inflows and prevent hot money coming in and going out at a rapid pace. The third was the exchange rate reforms. Some countries allowed their currencies to depreciate to address the overvaluation issue and restore competitiveness. This meant that now they could rebalance their trade and make economic policies around their new exchange rate. The fourth was the fiscal reforms. Governments implemented fiscal discipline measures to reduce budget deficit and to restore macroeconomic stability in the country. They focused on improving the tax system, on reducing wasteful expenditure, and on prioritizing public investments. The fifth was corporate and financial governance reforms. Now, several frameworks were introduced to improve transparency and accountability in the business sector. This included enhancing disclosure requirements, promoting independent auditing, and enforcing stricter rules on insider trading and market manipulation. Then there was debt restructuring that was introduced. Some countries negotiated debt restructuring agreements with their creditors to reduce the burden of foreign debt, and this created a more sustainable debt repayment plan. Finally, there was an enhanced role of the international financial institutions such as the IMF or the International Monetary Fund. Now, IMF played a significant role in providing financial assistance and policy advice to these affected countries. It emphasized on the importance of implementing reforms as a condition for assistance. It also created a series of bailouts or rescue packages, which I've also talked about in my previous video. Now, the final segment is about what were the lessons which we can learn from the Asian financial crisis. First is the importance of sound macroeconomic policies. Countries which had a strong fiscal discipline, which was maintaining its inflation and managing its exchange rate, were better positioned than those who were not doing any of these. The crisis also exposed the risks associated with heavy reliance on short-term capital inflows, which are also called as FII in India, particularly in the form of foreign currency dominated debt. Countries learn the importance of managing capital flows and reducing the exposure to volatile short-term financing, because this can go out anytime and it can hamper the growth of the nation. The third lesson was that there was a need for robust financial regulation and supervision. Countries realized the importance of implementing robust regulatory frameworks, enhancing transparency, and strengthening the risk management practices to prevent excessive risk taking and ensure financial stability. If loans are given out, you need to have proper risk management practices associated with it. Then this crisis also highlighted the importance of a flexible exchange rate. The Asian countries which had fixed or pegged exchange rate regimes were the most affected. The crisis taught the value of having exchange rates to be more flexible, which can help absorb any kind of external shock which is seen in the outside countries. Finally, the role of international financial institutions was highlighted and it was understood. This crisis highlighted the need for effective international cooperation and support. Without the IMF bailout packages, probably it would have been difficult for these countries to come back on their path of economic growth. For example, the Chiang Mai Initiative, which is basically a multilateral currency swap agreement. Now, I'm not going to go into the details of this, but this is basically a pool of forex reserves which has been created by the members of ASEAN, China, Hong Kong, Japan, and South Korea to manage short-term liquidity problems among these countries and to prevent over-dependence on the IMF. Hence, the need for regional cooperation was felt and understood, and these kind of initiatives came into the picture. The G20 was another such initiative which took an active role after the Asian financial crisis. Finally, what was the lesson that the investors drew from the Asian financial crisis? It was a reminder to the investors about the risks of investing in emerging markets. It also highlighted the importance of conducting thorough risk assessment, understanding the vulnerabilities of the countries they invest in, and also diversifying their portfolio so that they do not lose a lot of capital. In conclusion, the 1997 Asian financial crisis was an important episode in the economic history of the world. It was not only a financial crisis or an economic crisis, it was also a crisis of governance at all major levels of politics. There were a lot of countries which were affected, and there were very important lessons regarding regulatory oversight, proper risk management practices, and ensuring regional cooperation, which could be learned from the Asian financial crisis. I hope you like this video. If you did like the video, please do comment in the comment box down below. Please let me know which other topics would you like me to cover in my subsequent videos. I'll see you the next time. Till then, take care, stay safe, bye.